Stablecoins are moving beyond crypto trading into regulated financial infrastructure. In this session, we'll look at how issuers, reserves, distribution, compliance, and regulation shape stablecoin business models, and what those choices mean for product strategy and revenue. We've moved from the broad regulatory challenge to the emerging US framework: clarity, genius, and stable. Now we'll turn that policy foundation into business strategy. The question is, which stablecoin model fits which use case, and how do reserves, banking relationships, and compliance shape the answer? One useful way to compare stablecoin models is to ask four questions. Who issues the token? What assets support it? What claim the holder has? And which regulator can supervise it? Fiat-backed payment stablecoins look most like a new payments instrument, supported by cash, treasuries, repo, or similar liquid reserves. Tokenized deposits stay closer to traditional banking because the token represents a bank deposit. Bank settlement tokens are usually wholesale tools for institutions. Algorithmic and crypto-backed designs rely on market mechanisms or volatile collateral, so they fit less cleanly within emerging US policy frameworks. Fiat-backed payment stablecoins work like a narrow payment instrument. A customer deposits dollars. The issuer mints an equal amount of tokens, and those tokens move through wallets, exchanges, and merchants. The trust anchor is the reserve portfolio: cash, treasury bills, reverse repo, and other liquid, low-risk assets intended to support one-to-one redemption. When a holder cashes out, tokens are burned or retired, and fiat is paid back. The commercial promise is speed, programmability, and global reach. The regulatory focus is reserves, redemption rights, audits, disclosures, and supervision. A fiat-backed stablecoin is only as strong as the assets behind it. Cash and bank deposits provide immediate liquidity, but they also create dependency on banking partners. Treasury bills are often the core reserve asset because they combine liquidity, low credit risk, and yield. Repo can help manage short-term cash needs, but it adds counterparty and operational complexity. The red zone is anything hard to value, long duration, risky, or opaque. For payment stablecoins, reserve design is not just investment management. It is the credibility engine, the liquidity buffer, and the regulatory proof point. The core promise is simple. One token should come back as $1, or the stated fiat unit. Issuance and redemption are the operating mechanics behind that promise. The issuer receives fiat, confirms the funds, holds the backing assets, and mints matching tokens. When customers redeem, tokens are removed from circulation, and fiat is paid out. The real test comes under stress. Large withdrawals require real liquidity, reliable banks, tight controls, and enforceable redemption rights, not just a promise to sell assets later. Reserve quality matters, but adoption also depends on proof. Users, exchanges, and enterprises need confidence that the assets are really there, can be sold quickly, and are not mixed with the issuer's operating funds. Regular attestations or audits create that evidence by checking reserve balances against token supply. Transparency reports add detail, such as asset mix, maturities, custodians, and redemption terms. Segregated reserves reduce the risk that customer backing is pulled into insolvency proceedings. For institutions, these controls are not optional. They are the due diligence required before stablecoins enter payment workflows. Tokenized deposits are best understood as bank deposits with a new digital interface. The token may move through wallets or payment networks, but the underlying claim remains against a regulated commercial bank. That matters because existing supervision, customer due diligence, account records, and payment controls can still apply. The benefit is programmability. Payments can be automated, conditional, or embedded into digital workflows while retaining the legal character of bank money. The trade-off is reach. Access may depend on bank networks, permission systems, and interoperability between institutions. Stablecoins and tokenized deposits can feel similar in a wallet, but they represent different legal and strategic models. A payment stablecoin is typically issued by a permitted non-bank or bank-affiliated issuer, and the user has a redemption claim against that issuer. A tokenized deposit is issued by a bank, so the user's claim is a deposit claim within the banking framework. Distribution also differs. Stablecoins can move through open wallets, exchanges, and fintech platforms. Tokenized deposits often fit bank networks, institutional settlement, and regulated treasury use cases. Bank-issued settlement tokens apply tokenization to wholesale money movement, not consumer payments. A bank, treasury desk, or institution can use a permission token to settle obligations faster across trusted participants. Because the network is permissioned, identity checks, compliance screening, limits, and monitoring can be built into the workflow rather than added after the fact. Consortium models take this further by sharing common infrastructure across banks, fintechs, and market utilities. The hard part is not the token itself. Adoption depends on legal finality, liquidity, interoperability, governance, and regulatory approval. Stablecoin regulation is drawing a perimeter around issuance. The key question is no longer just whether a token can find users. It is who is legally allowed to issue it, and under what controls. Frameworks like the Genius Act emphasize permitted issuers, high-quality reserves, redemption rights, disclosures, and supervision. The Stable Act perspective pushes harder on banking risk, systemic exposure, and compliance. Banks and non-banks may both participate, but under different licenses, examinations, capital expectations, and operating constraints. In practice, regulatory status can determine whether a stablecoin business model is viable at all. Stablecoin economics are more than minting and redeeming tokens. The core engine is the reserve. If assets sit in treasury bills or similar instruments, the issuer may earn yield while still promising one-to-one redemption. Around that engine are operating revenues, such as payment acceptance, transfers, conversions, and settlement services. Partnerships can accelerate adoption through wallets, exchanges, fintechs, and processors, but they often require sharing economics. Treasury management matters too, because scale can improve liquidity planning. The key constraint is regulation. Reserves are meant to protect users, so revenue opportunities must not compromise safety, transparency, or redeemability. Regulation can improve trust, but it also changes the economics of issuing a stablecoin. The business is no longer just mint, redeem, and earn yield. Issuers must fund licensing, KYC, and AML controls, sanctions screening, monitoring, reporting, and legal review. They also pay for reserve custody, banking partners, audits, attestations, and liquidity operations. Then comes smart contract security, wallet infrastructure, cybersecurity, incident response, integrations, support, and distribution incentives. The mental model is simple. Net margin equals revenue streams minus operating and compliance costs. Profitability depends on scale, interest rates, and how efficiently the issuer runs this cost stack. Choosing the right stablecoin model starts with the customer problem, not the technology. Retail and remittance products need reach, simple access, and trusted fiat backing. Corporate and B2B products need controls, liquidity, auditability, and dependable integrations. Bank-led strategies may fit tokenized deposits or permission settlement networks. From there, test the economics. Who holds reserves, who earns yield, and who carries compliance costs. Finally, weigh licensing burden, partner dependency, interoperability, and reputational exposure. A strong model is not just profitable, it is aligned with the institution's capabilities and risk appetite. The key point is that stablecoin strategy is not just a technology choice. Fiat-backed models lead today, while bank tokens and tokenized deposits offer tighter integration with different access trade-offs. Reserve design drives revenue, cost, and trust. Regulation shapes what can be built. Next, we connect these business choices to product design, risk, and compliance.